All right, so let's see. Good afternoon, everyone. Welcome back to Mezo Investment Club. Today, we're wrapping up Unit 1 by covering some more investment strategies and tips. As you may already know, I'm Ryan Wang. I'm a rising junior at Green Hills, a school in Ann Arbor, Michigan. All right, let's just move on. So yeah, my organization here is trying to teach students, economics and finance. Our goal is to create a platform for students to learn more about this kind of stuff. And even if you don't intend to go into these fields in the future career-wise, I still think that it's important for you to understand the basic concepts to better inform what direction you may want to take in life. So just to reiterate our current schedule for the program, we're currently wrapping up Unit 1, which is about basic stock market strategy. Moving forwards, we're going to start Unit 2 next week, where we'll dive into, I'd say, the really complex and fascinating financial world. And then, as I was talking to Mira, we're hoping to do Unit 2 and then Unit 3. We might not get to Unit 4. We're trying to end at around early to mid-August, just to prepare for the school year, fall sports, if that happens. So going back to week 1, we looked into the basics of the stock market. We touched on what stocks are. They're just legal claims to pieces of ownership of a company. We also discussed your rights as a shareholder and what powers you may have within a company that you have ownership in. Then we moved into why companies may want to go public and issue stock. And by going public through an initial public offering, companies issue stock mainly to raise capital, which can be used to grow the company, finance its projects, just expand growth in general. And then another thing that we talked about is why we should care about investing and learning about the financial world. And then finally, we discussed market prices and what they represent in terms of what investors believe the company is worth. And then last week, we started looking into basic investment concepts and strategies. One of the first concepts we covered was this relationship between risk and reward. Risk, if you recall, is the possibility of loss. And in a financial context, risk is the possibility of receiving less return than expected on investments. Reward, of course, is what you get in return for investing what you invest in. And the reward on assets is usually positively correlated with risk. So high risk, high reward. One more thing that we talked about was the two different kinds of risk. You have systemic risk, which is the risk of broader trends that impact the overall financial system affecting your investments. Then you have idiosyncratic risk, which refers to company or industry specific factors that may affect your investments. And of course, you can try to employ diversification to try to mitigate that idiosyncratic risk. And then after that, we also looked into two particular investment strategies, value investing and growth investing. Value investing tries to determine the intrinsic values of companies and compare that value with the current market price. If a company's intrinsic value is below the current market price that its stock is selling for, then you should probably buy that stock, and vice versa. And then growth investing is about picking stocks whose companies are expected to grow in the future. Growth investors, some people will say, are always looking for the next big thing. So like Apple, Netflix, and Amazon when they first started. And then, so that was just a quick summary of what we got to cover last week. And let's get started on today's lesson.
Oops. Okay, so now we'll start talking about market indexes. Market indexes sound far more intimidating than they actually are. As a matter of fact, you probably already know some. Market indexes are the Dow Jones, S&P 500, and NASDAQ. Often they represent sectors of the economy, but alternatively can be used for any grouping of stocks. For example, you can make an index for automobile companies or an index based on a company's location. Ultimately, a market index would look like a stock with stock price, except the price takes into account multiple different companies. When investors are looking at market index, they usually don't care about the actual price of the market index. What they actually care about is the movement of the index price. Such movements are representative of the overall trend of the companies being grouped in the index. Each index has its own method for calculating its price. They usually use a weight system where they emphasize the importance of some companies over others by assigning it more weight, which means that the stock price change of one company will be more influential to the market index price than another company that's given less weight. The Dow Jones tracks the 30 biggest publicly owned companies traded on the New York Stock Exchange. Meanwhile, the S&P 500 takes a broader approach and averages the top 500 companies of the New York Stock Exchange. The NASDAQ is the most complicated of the three because it's more diverse. It's a compilation of more than 2,500 different stocks and a variety of other investing options. For example, real estate or whatever you want. Investors evaluate market indexes to see how well a part of the economy is doing. At the beginning of COVID, a lot of companies took a hit and their stock price went down. This was reflected in the indexes when people wanted to see how the economy was doing or how it was recovering when they looked at the market index. This is also a good way to prove that you should invest your money when you are young so that you have a lot of money when you're old. If you look at the trend of the NASDAQ in the past 20 years, the value almost doubled despite things like the crash of 2008 or even COVID. So next we'll be talking about monument investing.
Yeah, so last week we covered value investing and growth investing, and this week we're just going to focus on momentum investing. It's pretty interesting, but basically I know that this might be a bit of a information overload, but really we're just trying to like take you guys on like a brief tour on each of the different strategies so that you guys understand what they are. But if you actually want to like specialize in one of these strategies, then you should probably do a bit more digging on your own. And we're hoping to, in the near future, create some more videos on our YouTube channel that cover each of these investing strategies more in depth. So momentum investing. So this type of investing can be simply described as investing based on market trends. The idea behind this trading strategy is to capitalize on market tailwinds from beginning to end. So allowing industry or economic wins to fill your sails. Momentum investors go long for assets showing upward trend prices and go short for assets showing downward trending prices. So this goes back to what we were discussing in our stock market section about long positions and short positions. So for example, if you were a momentum investor, you would buy Netflix, whose revenue has compounded like around 30% annually. You'll keep holding onto it until it stops growing. And well, if you think about it, this could actually be a bit problematic because pure momentum doesn't actually take into account the account price. For example, imagine if you own a farm, you'll never pay $100 for a plot of land if that land can only yield around $20 worth of crop. The same can be said for Netflix. If you think that a business is worth at most around 150 million, you wouldn't pay 250 million for it. So that's the issue with momentum investing. Sometimes, you follow up and down with like bubbles and crashes, and sometimes it doesn't work. So that's like a major disadvantage of momentum trading. And momentum investors usually try to use something called technical analysis to better inform their decisions. A technical analysis is a trading discipline used to evaluate assets through the analysis of statistical trends. Basically, investors that use this type of analysis look into all sorts of statistics, such as past price history, price movements, and trading volume. This contrasts with fundamental analysis, which we talked about last week with when we were discussing value investing. And basically, fundamental analysis is just really looking into value investing and fundamental analysis is really looking into the basics, the fundamentals of the company. So that means like the business model, what the executive board looks like, what the CEO is thinking. And then for technical analysis, it's a bit more numbers orientated. So then you have more statistics such as price movement and trading volume. And now we'll talk about bonds.
So besides stocks, there are other assets that you can invest in, and one of those assets is called bonds, which we'll be exploring today. So a bond is a fixed income asset that represents a loan made by an investor. Bonds are essentially a more formal IOU, where the details of the bond are agreed upon by the borrower and the lender. So these details include the amount loaned by the investor, which is called the principal, and the interest rate. Bonds are usually paid back to the lender over a period of time with some interest. So this is why bonds are considered fixed income assets, because the lender has some income with the loan being paid back over time with the interest. Once the investor has paid back the principal amount, the bond matures and the payments end. So for some more terminology, issuers of bonds are the borrowers of money. They borrow money for many reasons and they can look very different. Issuers of bonds borrow money so they can get loans and increase capital at a fairly lower interest rate than they would at a bank. Issuers also issue bonds to attain more money than the bank might give them for a certain project. This way, they can get the money from the bank, but they can also get the money from a lender as well. So not only companies can issue bonds, but the government issues bonds quite frequently as well. They issue bonds to fund infrastructure, war, and other public projects. So let's look at an example. So let's say that the city of Ann Arbor wanted to build a new park. The issue bonds that have a principal of $1,000 will be paid off over 10 years with an interest rate of 5%. So an investor can buy the bond for $1,000, and every year they will receive a payment of $50 until the bond is matured. So in this case, the bond would be matured after 10 years. So bonds are very frequently used in ways all around us, and there are many different categories and types of bonds that can be issued, and there are certain ways to price and calculate them. Bonds are often a good option for investors because they're less risky than investing in stock, and they also provide a stable income of money. Bonds also benefit the issuer who is getting money to put in a project, and at more often than not, a lower rate than they would at the bank. So now we'll talk about limit orders.
Before we go into like all the stock market stuff, we actually have a guest speaker, Peter, who works at I'm not too sure how to pronounce this, Bezates and Sons.
Yeah, that's fine.
Yeah,
how's everyone doing?
Yeah, they're an agricultural development operations investment firm, and he has some experience in the financial industry. So yeah, thank you for coming.
Yeah, no problem. Happy to listen to the rest of the presentation and then get into a little spiel. But I'm happy to sit back for a while you guys finish out.
Yeah. One more thing before you start. Feel free to ask any questions while he's doing his presentation, and when he finishes, we'll have like a little Q&A section, and we'll be happy to go through these questions and see if he can answer them for you. So.
Do you want me to go into it right now, or were you going to talk about limit orders or something like that first?
Oh no, we're doing this now, and then we'll go into stock market stuff.
Okay, great. So yeah, how's everyone doing? So Ryan, how many people do we have on the phone? It's like four or five people here. Or
yeah, we have around 7 panelists, and then we have 25 attendees.
Oh, okay, great. Wonderful. And so it's all current Green Hill students mostly.
No, we reached out to Green Hills, a few other schools in Ann Arbor, and I think we have a few students from other states as well. So.
Oh, okay, very cool, very cool. So I guess the connection that I have with Ryan here is that I was a former Green Hill student very long ago. I graduated in 2007, and I played tennis at Green Hills. And I actually still play tennis with Mark Randolph, who was my coach back then on the team, and he's an English teacher still at Green Hills, and so he hooked me up with Ryan, and just kind of knowing that this club overlaps a little bit, or at least kind of tangentially, with some of the stuff that I do professionally and that I've done in the past. And so happy to join on and give a little bit of my experience. Maybe the best thing to do, I think, understanding that everyone's, I think, still in high school here. Maybe I'll just go back all the way to to college and talk just quickly about my college experience, and then kind of initially, what I did professionally, what's interested me, professionally, what's interested me like extra professionally, primarily in kind of finance, investing, et cetera. And then really, probably, you don't want to hear me drone on for too long. So any sort of questions, that you have directly about my experience, or things maybe from my resume that stood out to you that you want to know a little bit more about. It's probably best to get as much back and forth as possible. So just running through it really quickly to see if anything kind of sticks out to anyone. I graduated Green Hills in 2007. And my senior year, I took I don't know if they still do micro and macro econ at Green Hills, but I took those econ courses, and I really liked them, and I was pretty good at them. So I knew that Econ was something that I wanted to at least try out in college to kind of see how I was doing. I went to Dartmouth College in New Hampshire, and I kind of came in thinking that I was kind of like a math science guy. I always thought I was, comparatively good at math science, or that kind of came a little bit more easily to me. When I got to college, I kind of, went there and I immediately took like the hardest calculus class that I could. I took some like honors multivariable proofs class my freshman fall. And I was like, you know what, I got this. I did really well in, in Calc BC, and this is just a little bit of a step up. And so I got it. I remember like the first exam was at like 5:30 p.m. one day. And so I was sitting there the day before and I was thinking, oh, this exam isn't until 5:30 the next day. I can just wake up early in the morning and study all day, and I'll go take it at 5:30, no problem. And so I got out my stuff, and, I was studying, it was kind of the first third of, the trimester material. And then, I kind of was realizing like after lunch and mid-afternoon, like I really don't I don't have a good handle for this stuff. And so I took the test. It was basically like 10 proofs. So just like, basically to prove, kind of 10 relationships in calculus, and they would grade like 9 of them or something like that. And I remember just thinking that I was bombing like the whole way through. And when we got our exams back, a week later or whatever it was, there was like this histogram of the distribution of scores in the class, and I had like, out of like 40 people or something like that, I had like the third lowest score in the whole class. And so at that point I was like, maybe I overextended myself for a little bit with class selection, or definitely I need to try a little bit harder going forward. And so everything turned out well in the class, but that was a little bit of of a wake up moment for me, just kind of understanding maybe I wouldn't want to call it competitive landscape, because college really isn't supposed to be competitive, but just kind of understanding where maybe my strengths and weaknesses are, and what I overestimated and what I underestimated. I think that generally at least coming from Green Hills, I was actually a lot better prepared to do all of more of the kind of writing and reading heavy classes versus the hard sciences and math and stuff like that. But I think that I got into econ because I think it was kind of a good mix of the quantitative and the theoretical. Took some econ classes, did really well with them, and kind of just decided to pursue that as my major. And back in, so I was graduating around 2011, and I know there's kind of been some paradigm shifts since then in terms of kind of what the best and brightest go into right after graduation. But I knew I wanted to go to New York. I had a lot of friends going to New York, and I wanted to do some type of some type of reputable job at a reputable company or something like that. I really didn't know exactly what I wanted. I probably didn't think about it enough in advance. But a lot of people, who did econ or sort of, business type undergrad, at the time, most went into management consulting or investment banking or something like that. So not really having a kind of a distinct view of what I wanted to get into. I did 3 years of management consulting, which is basically, you're a consultant, you go work for some big company that has a business problem, and you use some type of analytics or kind of strategy plus analytics to solve business problems for big clients. And then you maybe go to another industry with a different client and do a problem for them, or you stay within the industry, or stay even within the client and do some sort of like upsell engagement with them. And so that was interesting. I wouldn't necessarily say that it like gave me like life-giving energy, but it really helped me kind of get an initial understanding of what it meant to kind of be a professional, what it meant to work in in kind of a high stakes environment where you have high expectations, which frankly kind of really wasn't the case like on a day-to-day basis, at least in college and definitely not in high school. So that was a little bit of an adjustment. And then, beyond that, it kind of, helped me, fill out sort of like an analytical and like a quantitative skill set, which basically means Microsoft Excel, taking what you learn in Excel and flipping it over to PowerPoint or some other type of presentation. And so there was definitely a lot of that early on. Maybe not the most glamorous work, but it was quote unquote prestigious or whatever you want to call it. And put me in a position to kind of do maybe more interesting higher level work kind of later on, and gave me again that kind of baseline skill set to do well in those later jobs. Sorry, I'm just getting a call in here. While I was in management consulting, I did I did some engagements in healthcare. It was right around, the Affordable Care Act, and there was a bunch of, changing kind of standards and rules and regulations that impacted healthcare providers and healthcare payers and kind of other, industry participants, kind of extremely. And so I ended up kind of specializing in healthcare for maybe I was there for 3 years, and maybe like the last year and a half, I did mostly healthcare engagements. And so I kind of thought, oh, hey, this healthcare thing is interesting. I also want to kind of get maybe a little bit more into the investing side of healthcare, on the earlier stage. And so I joined a healthcare venture capital firm, basically, investing in early stage healthcare technologies and doing sort of like early stage healthcare company building, et cetera. And I was there for the next 18 months. And this isn't kind of what I got into it for, but is a little bit bit surprisingly, probably the biggest project that I spent the most time on was, so I was in New York, and there were new regulations that were coming out that were allowing the use of medical marijuana in the state of New York. And obviously New York is a really high population state. They were giving out 5 licenses, so kind of these individual license holders were theoretically positioned to capture just a lot of market value. And so I kind of went on this process of looking into starting a new company to go after one of these 5 licenses in the state of New York. And kind of partnering with the right people and spinning up a business plan and getting an application together and kind of getting financing and everything like that. And so that was basically like maybe a 9 to 12 month saga where I really dove deep into the industry and really kind of owned a project myself. We ended up doing a lot of really, really interesting things. We kind of recruited a core team. We partnered with an operator in the space out of Colorado, and we raised a significant amount of money. I think it was over a little bit over $20 million to enable the business. And so it was a very, very interesting experience. With a lot of uncertainty, a lot of interesting personalities. At the end of the day, we ended up not getting the contract, pretty surprisingly, I would say. Which there's a whole other story whether that was a blessing in disguise or not that I could maybe get into some other time. But through that process, I mentioned that my group kind of partnered with an operating team out of Colorado. Through that process, got to know that operating team out of Colorado really closely, and also know their principal financiers really, really closely. And after that process was over, the principal investors in that operating company in Colorado, they're primarily agricultural investors. Done a lot of things across a lot of ag verticals. And, they said, anytime you want to, join up with us, we're doing a lot of cool projects, and, we'd be happy to have you join. And so maybe about 9 months after that, there's still a couple things that I wanted to accomplish, at my current role, in healthcare. But about 9 months after that, I joined up, with the agriculture investors, and have been working there for over 4 years at this point. And so what we do is we we do a number of things, but we kind of see ourselves as an agricultural development company. So this is essentially private equity into agriculture, where we do a significant amount of ag real estate investing. So farmland investing, and we try to look for really good opportunity and risk adjusted returns in farmland. And then what we like to do is we like to build businesses on top of that farmland, so greenfield businesses kind of from the ground up on top of that farmland. So that's basically buying assets and kind of creating enterprise value on top of those assets. And so we have two businesses that we have founded, that do just that. One is a seed and fresh potato business, that's based out of Minnesota, Arizona, and Oregon. And the other is a grass-fed organic beef business, that's based out of Central Georgia. And so those are our primary operating businesses that are kind of control investments for us, so we control them. And then we do a lot of kind of passive, more standard private equity or venture capital, type investing on the side, with a relatively lower kind of proportion of our portfolio. And so those are kind of food and ag tech related, venture investments. And so that's essentially my role right now. I don't know, I think I maybe went on for 10 minutes. So kind of beyond that, and I don't know if this is something that you guys are interested in as well, I have never been like a public markets investor, professionally. But I have, managed my own money, over the last 10 years, and, been able to kind of do some more interesting things as that's grown. And so I maybe have some perspective on not being, a public markets investor professionally, but kind of doing it for my own personal account and kind of my, my philosophy around that. So that's something that we can get into a little bit more, but maybe I'll just pause there. And even like all the way across the spectrum, if anyone has a question, even about kind of how I approached, my college decision, or how I approached, time in college, or to kind of tips, for time in college, retrospectively thinking back, what are some things I would have done different, or any of kind of my professional experience. If there's any questions or any sort of, topic that you want to hover over, maybe I'll just open it up to the group.
Yeah. So looking at some of the questions here, a lot of people are just really interested in like the day-to-day operations of what you do as like a financial analyst, working for an agricultural development firm. It seems like, I would say, agriculture itself, I think, gets kind of a bad rap, where it's just like, it seems like it's really like detached from the rest of the industrialized world, where you just have like a bunch of farmers going out and farming, whereas finance in general is more like really high tech, fast paced, in the city. So I think that like it's just really interesting to see like kind of these two worlds, collide in the 21st century, and how there's like such things as agricultural development firms.
Well, yeah, I mean, everybody, eats every day, right? And, you look down and whatever you had for lunch today, and it's a plate of food, or it's something that you got from a restaurant or something like that. And, you were able to pay like $7, $8, $9 for it, or whatever it was. And, these are basically, ingredients, that are coming from all over the world, or all over the country. They're getting planted, grown, harvested, stored, shipped, processed, shipped again to retail, packaged, and then onto your plate for like, less than $10 or something like that. And that's a supply chain that is, it's one of the most interesting things in the world to me. how does food get onto your plate, and how are we able to do it for so cheap, because there's so much complexity in there, right? And so it's that whole food chain in which we operate. And there's obviously a lot of complexity into it. It's asset heavy, so it requires a lot of investment. There's obviously various return profiles for different portions of the supply chain. And basically what we're trying to do is is kind of understand where there's a potential for outside returns in a certain supply chain, and then figure out exactly how to piece together the assets to maximize the return of the capital that it takes to get those assets. Which part of the supply chain do we want to own, which part does it make sense to rent, and how does this kind of pull together into a cohesive business. So this is really, it's not really like financial analysis or anything. I mean, we do a bunch of financial analysis and we've got everything like that, but basically we're building companies and we're kind of creating value in a vertical that we have expertise in, and that's essentially what we do. I don't know if that answers the question. I think I didn't understand the question as much, just because these global supply chains are they're kind of very integrated with the rest of the world.
Right.
It's a huge business. I mean, food is a multiple $1 trillion business every year, and then even these individual verticals in which we're operating, like beef is $100 billion business, potatoes is a $30 billion business. I mean, these are huge businesses, and they're kind of inextricably linked to everyday life for every single human, right? Everyone's going to continue eating, and kind of finding out to me, it's kind of a very, very stable place to operate. And everyone has a personal connection with it. So I guess the day to day is when you're kind of running businesses and when you're kind of an entrepreneur, it's a lot of it is just a lot of it you're kind of setting you're setting goals, and you're trying to kind of execute on those goals, but a lot of it is kind of reactive to just whatever the business needs at at a certain time. So we've done a lot of things. I mean, just for instance, we have a we wanted to do a big expansion in our Arizona business this year, and so we so we raised external capital. We raised $5 million of external capital. We probably we raised $8 million of debt, so $5 million of equity, $8 million of debt. And we use that to basically buy land, other assets, build a larger wash and pack facility, build larger storage, do all the electrical, secure all the seed that we needed to flow through our growing operation. Got contracts with with growers in the area to so that we kind of sold them the seed, and we bought the progeny of their crop, and then we run it through our facility. We have all the marketing relationships, and we're shipping this stuff all over the U.S. and Canada. I mean, it's just every business is different. Every business is complex, and I think that's what really energizes me, is just building businesses. And I think it can be any topic, any any industry, but if you're kind of on the front lines of decision making with respect to building a business, I think you can make anything very, very, very interesting. It's it's building your team, it's dealing with customers, it's building your sales, it's refining your unit economics. So a very kind of broad range of responsibilities day to day.
Yeah. I have 2 more questions for you. The first one is, how are you able to raise so much money for your new business? Like, I believe it was the $20 million figure that you put out.
Yeah, I mean, you raise money by essentially giving people, and we put a lot of our own money into this business as well, but you raise money by interacting with a lender or some sort of equity investor or something like that, and giving them a compelling story about why they're going to get a good return, on their capital, right? So the capital raising process is, it's definitely a tough process. People spend their whole lives, earning money or raising money or something, right? And then they want to put it to something, and so you are then kind of the controller, the fiduciary of like someone else's hard-earned money. So that's kind of a high bar to to cross for a bunch of people. But basically, in terms of like tactically, what needs to happen to raise money is you need to have a business, you need to have a vision for the business, you need to and it needs to make sense, financially, right? You need to have a path to grow the business substantially. And when you grow the business substantially, you need to have positive unit economics, at scale, right? So it's really easy to grow a business if you're saying, hey, I'll give you $100 bill and you give me $99, right? You could grow a business as fast as you want to, but you're going to just be losing money the whole way. So it's about growth plus the ability to have strong kind of insulated unit economics at scale, and you need to be able to tell that story, both kind of quantitatively, spreadsheets, modeling, projection, stuff like that. And then in person and through other sort of kind of marketing collateral, and have a lot of conversations with a lot of different potential financing partners, and some like you and some don't, and you kind of pick the best offer that makes sense with the organizational structure of your business, investors' ability to kind of add value down the line, and you kind of just go from there.
Or yeah, and then final question: do you have any tips for personal investing?
Tips for personal investing is, I think the best tip for personal investing is, number one is kind of just like, for young people, is just kind of low fee index funds. Is gotta be the foundation. If you think that, you're smarter than other people out there picking stocks, especially if you're in high school or something like that, you're just not. Right. And there's a bunch of professional investors out there, and most of them are right less than 50% of the time. Right. So kind of, extending that to, someone with no experience. Sure, you can get lucky, or you can, you can be, right for a period or something like that. But over the long run, it's really about, getting indexed to the market and not paying a lot of fees. Now, I think that, investing, and so for most of my net worth, well, first of all, most of my net worth is in, these businesses that I own, and kind of, these farmland assets and stuff like that. But most of like my liquid net worth is in index funds. And it's in cash, yielding as much as possible. And then kind of with the remainder, I do some individual stock picking and some other sort of asset classes and stuff like that. And I've been relatively, successful doing that. I think, the really interesting thing there is, you put a little bit of skin in the game, you put a little bit of risk on the table, and that really compels you to learn more about these companies. And in learning about the companies, you're just kind of like learning about the world and learning about current events. And so, I think the best thing to being a good stock picker is just being, just being a really curious person and reading a lot. And so, like, if you're trying to pick these stocks, but you also, don't like to read, and you don't like research, then it's going to be a little bit like throwing darts at a board. But that's essentially the philosophy for, kind of personal finances and investing is, if your employer has some sort of a 401k match, right, then you want to max out your contributions to your 401k so that you're getting a match. Everything kind of above and beyond that, you want to be kind of like heavily weighted in, in index funds or something like that. And then pretty much only kind of bet beyond that as as more of like a learning experience, and then you'll probably find your niche or find something that you're find some sort of formula that you're comfortable with beyond there.
I mean, I would definitely agree. We're definitely going to talk about things like mutual funds, index funds next week when we go into Wall Street. So I know that Some of these people might not know what those are, but
Yeah.
there's definitely something to keep in mind.
Cool.
All right. Thank you, Peter.
All
Really
set?
really good stuff. Yeah.
All right. Thanks so much, guys.
Take care.
Yeah.
All right. So we're going to change up the structure a bit today. So we're going to first talk about some stuff about the stock market game, and then we're going to do our Kahoot. And then if we have time, we're going to go into rankings and see if any of the people on our leaderboard want to share what they kind of did this week. So I'm first going to talk about limit orders and stop orders. And you might have already seen this when you were on Market Watch, but we're just going to clarify what these really mean. It could be like a bit difficult to get at first, but I think it will get intuitive as you start to try to use it. So in the last few weeks, we've been talking about like everything we've been talking about were market orders. So buying, selling, shorting, and buying to cover are all market orders. Now, what does this mean? Well, a market order is to be executed immediately at the current market price, which are the prices you see at the moment for which stocks you are interested in. However, there are two other types of orders that you can utilize when trading, and the first type is called limit orders. These are orders that will let you buy or sell an asset at a specific price or better. So basically, you set a price threshold, and if the actual market price passes through that threshold, then your order will be eligible for execution. Otherwise, the order will not be executed. So unlike market orders, the filling of orders is not guaranteed. So for buy limit orders, the order will only be executed at the limit price or lower, because when you're trying to buy, you want the lowest price possible. And on the other hand, sell limit orders will only be executed at the limit price or higher, because when you're selling, you want the highest price possible. So here, I'll give an example. So if I'm looking to buy some Amgen stock, but I have a limit of $245 per share, then I'll enter a buy limit order with a $245 limit. Currently, the stock price is at 258.24 cents, so my order won't execute. However, if the price at any time drops to or below 245, then my order will be filled and I'll get my Amgen shares. So when do investors like to utilize limit orders? There are a lot of potential scenarios where using limit orders will be helpful when trading stocks. One such scenario is when the stock is being very volatile, meaning it's rising or falling very quickly, and investors are worried that a market order will give them an undesirable price. Another possible example is when investors might want to use limit orders when they're unable to watch a stock carefully throughout the day, or simply have a specific price in mind. Rather than missing out on an opportunity when the stock price does go to their preferred price, they can just use the limit order that will be fulfilled automatically. So say if you're like a student trading, you're like a student that has to go to school during the day, and you might not be able to keep track of stocks at any given moment, then you might have to set some limit orders just in case things like go out of control and you're not there to stop it. And then that's limit orders. Next thing is stop orders. So stop orders are very similar to limit orders. It's very easy to confuse the two because both have the same basic premise. If a price passes through a certain threshold set by you, then execute whatever order you want, either buy or sell. So basically how a stop order works is that your order will execute if the price moves beyond a desirable target. So for buy stop orders, you set a threshold where a buy order will be executed only if the price climbs above the threshold price. For sell stop orders, you set a threshold where a sell order will be executed if the price falls below threshold price. The intent of stop orders is to limit losses. So if a stock price is moving in the opposite direction of what the investor would like, a stop order places a ceiling on potential losses or a floor. So this is why stop orders are also called stop losses. Investors use these orders to try to stop their losses when prices go into unfavorable directions. When you're trying to buy a stock, it goes without saying that you want the price to be as low as possible. So, however, you can place a stop order at a certain threshold above the current market price, just in case the price suddenly rises and you need to buy it before it rises too high. This is the same mindset for investors who are looking to sell, except the exact opposite. So just like limit orders, stop orders have the same benefits of helping to reduce volatility risk and making it easier to make trades without constantly having to monitor stock prices. So, if you're doing the stock market game and you can't keep track of if you can't keep track of this price all day because you're busy with something else, then, set a few limit orders or a few stop orders, and then it will make it really just much more easier for you. All right, so that's what we have for the stock market game, and now we're going to do a Kahoot. So, let's see. Sorry, I'm trying to reshare my screen here. Yeah, I think my screen share is not working. Let me, hold on a second. We're running a bit short of time, so we're just going to start now, and you guys can always join as we go. Question 1. Which of the following is a market index representing the US stock market? Which of the following is the most broadly followed UK stock market index? Oh, wow, so a huge disparity here. So yeah, the FTSE 100 is the UK stock market index. A lot of you guys picked the S&P 500, which is, as you remember, a US stock market index, and also NASDAQ is also a US stock market index. Yeah, this is false. Warren Buffett is a famous value investor. Um, you have to understand the difference between growth and value investing. So yeah. Yeah, most of you guys got it. Yeah. You should establish a long position when you think that things are going up. So then you buy now at a lower price and then you sell at a higher price later on. Yeah, so things like future profit outlook, business model, and executive board members are all things that you would look at for fundamental analysis. Trading volume statistics, that kind of stuff is more numbers related, so that's more technical analysis. Yeah, most of you guys got it. The U.S. Treasury, corporations, and municipalities are all able to issue stocks. Individuals like us are not able to. Yeah, bonds are usually less risky than stocks because they're much less volatile. Stock prices, as you guys might have seen from the stock market game, they jump all over the place. Bonds are usually much more stable. Well, once again, a huge disparity here. Yeah, a buy limit order can only be set below the current market price. If you look at our slide here, um, limit orders for buying, you want it to be as low as possible, so that's why you set it below. So right here. Yeah, once again, I have to understand the differences between stop orders and limit orders. I would recommend, looking it up on Investopedia, a really great source. It's pretty confusing, but over time, I think that you'll get it. Yeah, this is just a bit of trivia here. Recently, the Nasdaq hit record highs. The Dow Jones and S&P 500 are all, getting up there, but once again, like they had a huge drop following the pandemic, so there's still a long way for recovery there. Yeah, the EU Central Bank headquarters is located in Frankfurt, Germany. It's good that not like most people didn't choose Russia or Turkey because I don't think they are Eurozone members. Yeah, most of you guys got this one. You guys understand the definition of liquidity and what liquid assets are, so that's really good. Yes, Karl Marx's work on the Communist Manifesto inspired communism, not capitalism. I'm not too sure what you guys are learning in history class for the people who picked capitalism, but no, absolutely not. Is our last question here. Yeah, it closes at 4 p.m. every day, and it opens at 9:30 a.m. every day. Great. Congratulations to Chloe, Period, and Anna Banana. Once again, no prize for you all, but congrats nonetheless. All right, we're just gonna. I think we're almost out of time here, but we're just gonna finish up with I have congratulations to the top 10 earners for this week in terms of the stock market game. I have Miles and Ishan on the call. Do you guys want to share anything about what you guys did? Your mindset, what stocks you picked, the overall strategies you might have employed? All right, I guess not. Moving forward, let's see. So looking ahead, next week we're going to talk about just the introduction to like Wall Street. We're going to look into the various companies, firms, and what they do. We're also going to look at mutual funds, ETFs, and also what Peter was talking about, index funds, which are really important for boosting your portfolio and whatnot. Once again, we have our YouTube channel where we're going to upload the meeting recording and hopefully supplementary videos soon. We're also going to have our we also have this new website that's up where we have our programs, and we're about to start hiring again. So if you're interested, take a look there. And we also have our Instagrams, and that's where we're going to talk about what else our organization is doing and what other activities or programs that we're having. So yeah, thank you all for coming out, and have a great week.